Let's learn about the income statement today. All right, so the income statement is one of the four main financial statements, the others being the balance sheet, the statement of cash flows, and the statement of shareholders' equity. So the income statement, first of all, you have to realize that income doesn't equal cash. And the reason that is because income is generated based on what's called accrual-based accounting. So this is a principle set forth by GAAP. And basically what this means is we record revenue when it is earned, and we record expenses when they are owed, regardless if cash is received or paid out. So the way to think about that is, let's say you have a lemonade stand, and a customer comes up, orders lemonade, you hand the customer a cup of lemonade, and the customer says, I can't pay you till tomorrow. You say, that's fine, just take the lemonade, go away, I trust you. Well, you're going to record that as revenue, and you're also going to record the expense of buying that cup earlier that day at Walmart or wherever you purchased it. You're going to record that expense as well. Okay, even though you didn't receive the cash. And what you're going to do is you're going to book an account receivable. We'll talk about the balance sheet later, but you delivered the product, and that's all that mattered. That's the only thing that matters. You delivered the product, and because you delivered the product, that's going on your income statement. And so ultimately what we're going to do is look at the cash flow statement as well, not in this video, in a later video. We'll look at the cash flow statement, and that's where we reconcile income with cash. But just for now, just realize that income isn't cash, okay? So let's take a look at what a basic income statement looks like. So a basic income statement looks like this. You're going to have net revenue or sales at the very top. That's the top line. And then you're going to start deducting things underneath it. So what are the things you deduct? Well, the first thing is the cost of sales. Sometimes that's also referred to as the cost of goods sold. That is the direct cost that you generate from making the sale. Okay, so in a lemonade stand, that would be the cost of the cup, the powder, maybe any wages you paid for the people that are actually working on the front line. If I subtract those two, I get this area in the blue, and that's called gross profit. Okay, gross profit is just revenue minus cost of sales. Gross profit. Now, the gross profit margin then is the gross profit divided by sales. So a lot of times people will calculate that number and just to compare different companies to each other. In this case, we happen to have a number of 50%. We don't really know if that's a good number or a bad number. It kind of depends on what industry this company is in. But for now, let's just know that that number is 50%. When we use the terminology margin, that usually refers to some number divided by sales. Okay, so let's keep going. The next thing we have down here is the selling, general, and administration expense. So this is what's often referred to as overhead, also with R&D, research and development. Overhead, this would be the cost of air conditioning, the cost of paying your finance department, the cost of paying the salaries in the marketing department, any advertising that's going on. A lot of costs get jammed in here for a lot of different firms, and these can be very high, they can be low relative to cost of sales. In this case, I just happen to put them down as $10. But this is your overhead along with R&D. So if I add these two numbers up, I get this number $15. That's my operating expenses. And my operating income then is going to be, it's going to be $50 minus 15. It's going to be, so excuse me, I'm going to start with gross profit. I'm going to subtract out my operating expenses, and I'm going to get operating income. And that's $35. That is also what's known as earnings before interest and taxes, or EBIT. Okay, that's an important number that comes up later, particularly if you're a bond investor. You need to know what this EBIT number is for different reasons. But this is a very important number, operating income. The stuff that comes after operating income are called non-operating expenses and income. The principal one being interest expense. So, to finance your firm, to start up your business, your lemonade stand, you had to borrow some money from the bank. You got to pay the bank back, so you have an interest expense. You might have other income or net gains related to financing. Maybe you invested some money and you earned some interest, or there were some other types of securities you sold at a loss. In this case, I'm assuming that's a loss. So I'm taking $35 minus 4 minus 2, and I get income before provision for taxes. Okay, so this is EBT, earnings before taxes, income before provision for taxes. Then I multiply that by whatever my tax rate is. In this case, I'm going to get a $7 income tax charge. I subtract that, and I get net income. And so when I look at this, my net profit margin is my net income divided by sales. So it's going to be this $22 divided by sales. And in this case, it's 22%. So I could compare that to another company in the same industry. I could also compare that to how did this particular company do last year? How did they do the prior year? Is this net profit margin getting better or worse? But every time I give this company a dollar, every time a customer gives this company a dollar, this company gets to keep 22 cents of that dollar effectively. Okay. Remembering, however, of course, that income is not cash. But at least they get to keep 22 cents on every dollar in terms of profit. Okay, so let's go and look at a real life example. Let's take a look at Walmart. This is Walmart's income statement for their fiscal year ending or business year ending January 31st, 2024. Every company gets to determine their own cycle in terms of when their year end is. Walmart happens to choose January at the end of January as their year end cycle. So you can see that their income statement looks a lot like what I just showed you. There's a couple of extra items, so we'll talk about those. We got net sales here. We've also got membership and other income. So you can think of Sam's Club probably is in there. Now, Walmart quotes all this stuff in terms of millions. So that's $642 billion that we're looking at here. $648 billion in terms of total revenue. All right, so now from that, we get cost of sales. Now, you notice after cost of sales, there should be gross profit. But we don't see any line that says gross profit, do we? Companies don't have to show that number, but we can calculate that pretty easily, right? Gross profit is simply going to equal that $648 billion number, and we're going to subtract out the cost of sales, and we got $157,983. So we could calculate a gross profit margin if we wanted to. We would take the gross profit number, divide that by sales, and then we're going to get 24.4%. Okay. So now, if we keep going down, and we'll look at net profit margin later, but if we keep going down, we start looking at the interest area, the non-operating stuff. And what you've got here is Walmart pays interest on debt. So they're paying interest on bank loans, and maybe they've issued debt in the corporate bond market, and they're paying interest on that. They've got these finance leases, which they're classifying as basically interest that they owe. They've got interest income, so you can imagine Walmart's probably got some cash sitting around, and with that cash they buy T-bills with it, or maybe some other short-term instruments, and they earn some interest on that. So this is, even though it's expressed as a negative number, it's negative of a deduction, so it's really money coming in the door, okay? And then, so the interest net, this line item here, this 2137, it's adding up these three things. So it's 2259 plus 424 minus 546. So this is an expense. The summation of all this stuff is 2137, $2.1 billion. We're going to take that number, put that in our pocket. Let's think about that for a second. They've got this other line item called loss on extinguishment of debt. I assume that's there because in prior years they had a number here. They don't have a number here, so we don't really have to worry about that right now. They've got this other gains and losses. If it was in a parentheses, it would be a gain. If it's not, it's a loss. So that is a loss. So you can imagine maybe Walmart, maybe they held some business that they divested from. We would find that in the footnotes, but that's going to be a loss. That's also going to be a hit to their income. So if I take that 2137 and I take that 3027 number, these two numbers right here, and I subtract them from this $27 billion number, I'm going to get this income before taxes. That's the EBT, income before taxes. That's 28,848. Here's their provision for income taxes. It kind of looks like they're paying a tax rate of about 25% if I do the math there. So the consolidated net income is $16.27 billion. So their net profit margin is going to be that $16.27 billion number right here, divided by their sales. It's 2.5%. That's a very low number. Okay, so anytime you walk into a Walmart and you hand Walmart a dollar, Walmart gets to keep in profit 2.5 cents of that dollar. Everything else goes off to pay off everybody they own, from employees to suppliers to who knows who else. So Walmart is a very low profit margin business. So you can imagine they got to have high turnover. They need a lot of sales to stay in business. And you can imagine you go to a Walmart and it's just crowded with people constantly buying things. So that you can get away with that low profit margin if you sell high volume. You have high turnover. Let's compare Walmart to a different company, completely different company. And of course, that's Nvidia. Let's take a look at Nvidia's income statement. And interestingly enough, Nvidia also happens to have a year end that coincides with Walmart, January 28, 2024. Their revenue is maybe a tenth of what Walmart's is. So even though in market capitalization in the year 2024, Nvidia is a bigger company in capitalization in terms of the equity value of their company, they sell 1/10 of as much as a product as Walmart does. Their cost of revenue, cost of sales, cost of revenue, $16 billion. So their gross profit is $44 billion. So let's take a look at their gross profit margin. It's $44 billion divided by $60.9 billion. 72.7%. That is a huge number. Big profit margin for Nvidia. Now you can start to see why investors are excited about this company. Also, what's not shown here is their revenue is growing very rapidly. And so that 60 billion is going to go a lot higher north than that over the next year. Okay, so if I go down, they've got R&D expenses, which are high for Nvidia. They're constantly trying to stay on top of the new chips that are going to be delivered into the artificial intelligence marketplace. They got SG&A at 2.6 billion. If I add those up, those are their operating expenses. That's 11.3 billion. So I subtract that 11.3 from the 44, I get their operating income. Okay, so that's their EBIT, earnings before interest and taxes. Now I start subtracting their interest and taxes. So here's their interest income. They actually have positive income. They have more income than they have in interest expense. Now, you would see this often from a tech firm. Why is that? Because technology firms tend not to borrow a lot of money. They don't borrow a lot of money just by nature. They do have a lot of cash sitting around, so they're going to earn more income usually than they're going to pay in expenses. A lot of companies aren't going to see that, but Nvidia does see that. So this is an inflow. This is a net inflow. And then they've got other net income. Now notice the difference with Walmart. This part here is if it was income with Walmart, it was in parentheses, but with the Nvidia, the income is positive. It's not in parentheses. And the opposite for expenses. So you have to kind of look at every company they have a little bit of leeway into how they express things on their income statement. It can be a little tricky, but you can always calculate that. You can take that $32 billion number, you can subtract this 866, you can add this, You can add in the 866. You can subtract out the 257. You can add in this 237. It gets you this net number of 846. It is income. I get this 846. I add it to this $32 billion number, and I get total income before tax of $33.818 billion. Okay. Now, they're going to pay taxes on that. That looks kind of like a low tax rate of $4 billion. Who knows? Maybe they got some tax deductions somewhere else, but that's pretty low tax rate for Nvidia. I'm assuming that they just had some tax assets that they were able to write to shield themselves from. So they had some tax shields that were allowed to lower their income tax, because the U.S. corporate income tax today is 21% in the year 2024. Okay, but overall, they've got a net income of $29 billion. You take a look at their net profit margin, that's 48.8%. That is a massive number, much bigger than a lot of companies that are in the U.S. today. So every time you hand Nvidia a dollar, and you probably don't as a person, Nvidia sells a lot of their chips to other businesses, so their customers tend to be other businesses like Apple and Microsoft and Google. Anyways, every time they hand Nvidia a dollar, Nvidia gets to keep 48.8% of that in profit. 48 cents, almost 49 cents of that in profit. That is a huge number. And so you can see how you can start comparing Nvidia to Walmart. You can compare Nvidia to its own history. You can do a lot of different comparisons. So if you like this video, please give it a thumbs up, and also please subscribe to my channel, because this is where students can come, learn about finance, do better on their exams, and this is where I make finance fun for students. So thank you.